The market maker. Picture the guy at a highway toll booth. He doesn't care where you're going or if you'll get there on time. He takes the toll, period. Market makers do the exact same thing on Wall Street. They don't bet on Tesla going up or Apple crashing down. They sit in the middle. They buy from sellers, sell to buyers, and they keep the difference between the two prices. It's called the spread, and it's a crumb. But that crumb they collect thousands of times a day on thousands of different stocks all at once. Citadel Securities, the undisputed king of this game in the United States, handles roughly 1 out of every 5 trades on the entire American stock market. 1 in 5. In 2025, they pulled in about $3.4 billion. And listen, they didn't make money by guessing which stock would explode. They make it by being everywhere, being insanely fast and skimming fraction of a penny of millions and millions of trades. This is where math turned into pure magic. 1 penny earned on 10 shares, a slice of pizza. 1 penny earned on a billion shares, a company worth 10 of billions. There's more. Market makers pay apps like Robinhood to receive your orders. Ever wonder what happens when you buy a stock commission free on your phone? Well, someone is paying on your behalf, and it's the market maker who buys the right to execute your trade. It's called payment for order flow, and it's what makes the whole system spin. So, get this straight. They don't need you to lose money. They need you to trade a lot. Every single time you hit buy or sell, whether you make money or lose it, you're paying the spread. And that spread is their paycheck. By the way, if you want to trade the right way and stop throwing money away, sign up for the free Trading Academy in the description. It covers all the flow and professional tools you'd only find in courses that cost 5 grand and honestly are often poorly explained. It is taught the right way, step by step, and it's completely free. You're welcome. Statistical Arbitrage. Picture 2 twins who always walk side by side and have been doing it for 30 years. Same pace, same stride, always. Suddenly, one of them trips or falls 2 steps behind. What do you think? Any second now he'll catch up and get right back beside his brother. Well, that's statistical arbitrage, or stat arb for the cool kids. It does exactly this but with stocks. Coca-Cola and Pepsi historically moved together like twins. If Coca-Cola suddenly drops and Pepsi stays up, the startup fund buys Coca-Cola, the one that tripped, and bet against Pepsi because the math says they'll snap back together. And this is where a legend enters the picture. Renaissance Technology, funded by a mathematician called James Simons. This is the absolute cathedral of this game. The Medallion Fund averaged 66% return per year from 1988 to 2018. 60% a year for 30 years straight. Nothing like it exists in the history of finance. Warren Buffett looks like an amateur in comparison. And how did they pull it off? Simons, who passed away in 2024, didn't hire the typical Wall Street sharks in suits and ties. He hired mathematicians, physicists, and linguists, people who hunted for hidden patterns in the numbers, patterns invisible to regular humans. 2 Sigma, DA Show, AQR, they all play the same sport, each with tens of billions under the hood. But why does it work? Because the market is never perfect. Price wobble, overreact, get it wrong for a few seconds, a few minutes, a few days, but then they snap back. These funds place thousands of bets all at once, each one with a teeny, almost laughable expected gain. But multiply that by millions of trades and you've got a money printing machine. The secret? You don't need to nail every single bet. You just need to be right on average across an ocean of bets. The high-frequency trader. Imagine being able to see the futures 2 milliseconds ahead. You'd know everything. You'd win every time. Well, high-frequency trading is exactly that, turning raw speed into money. These firms spend insane amounts, hundreds of billions of dollars, just to be fast. They put their servers physically inside the exchange buildings. They build microwave towers that beam data between Chicago and New York in just over 4,000ths of a second. They design custom chips that think in nanoseconds. All of these to beat everyone else by a fraction of a blink. How do they make money? Simple. When a stock's price change on one exchange, they see it first and rush to the other 15 exchanges before those even realize what happened. They buy where it's still cheap. They sell where people are still paying more. Basically, free money. A 2020 study estimated this game is worth about $5 billion a year on global stocks alone. And where do these $5 billion come from? From the pockets of the slower players, pension funds, bank, your managed savings, everyone who doesn't have microwave towers in their backyard. So, want a number that will blow your mind? Virtu Financial, one of the few companies of this kind that's publicly traded, revealed in official filings that they had a single losing day out of 1,238 consecutive trading days. One of out 1,238. That's not skill. That's not luck. It's a structural advantage that turns into a money printing machine with almost zero errors. And this is where the controversy kicks in. They say, we make markets smoother, we lower costs for everyone. But the critics fires back. Your liquidity is a ghost. It's there when the waters are calm, but it vanishes the exact moment a storm hits when you actually need it. So, who's right? Depends on which side of the milliseconds you're standing on. The index fund. This is the best story of them all, because it's the story of the grandpa who beats every hot shot on the Wall Street simply by sitting still. In 1976, a man named Jake Bogle invents something that sounds downright stupid. A fund that doesn't try to beat the market, just buys everything, all the 500 of the biggest American companies in proportion, and that's it. No geniuses, no strategies, no acrobatics. And Wall Street lauded him. Bogle's folly, they called it. Well, guess who's not laughing anymore? Today, Vanguard, the company Bogle founded, manages over $8 trillion. BlackRock manages more than 10 trillion. Together with State Street, these three giants control about 25 trillion and own significant chunks of practically every publicly traded company on the planet Earth. Apple, Microsoft, Ferrari, Coca-Cola, they own slices of everything. But how do they make money? With a fee so small, it sounds like a joke. Vanguard's S&P 500 ETF charges you 0.03% a year, meaning if you invest $10,000, you pay $3 a year. $3. But when you manage 8 trillion, even ridiculous crumbs like that turn into rivers of billion. And here is the stroke of genius. Their edge isn't being good, it's being inevitable. Studies show that active managers, the ones getting paid handsomely to pick the right stocks, lose to market about 9 times out of 10 over 15-year periods. 9 out of 10. Despite jaw-dropping salaries, despite having Bloomberg terminals on their desks, despite a team of analysts. So, every year that goes by, more and more people ditch active fund and jump into index funds. It's a snowball effect. And by now, most experts say there's no stopping it. Index funds don't try to beat the market. They are the market. And they get rich by charging the most ridiculous low toll to anyone who wants to hop on board, the dark pool operator. Picture a secret casino, hidden beneath the main casino. At the official tables, you've got the tourists playing the roulette out in the open. But downstairs, in a dark room with no windows, billionaires are making massive bets that nobody's supposed to see. These are dark pools, private exchanges, where big banks and big funds swap enormous block of shares far away from the eyes of the market. But why do they do it? Because If Apple wanted to sell $1 billion worth of stock out in the open, the price would crash before they even finished the transaction. In the dark, though, they trade in peace. And who run these hidden venues? The usual names: Goldman Sachs, Morgan Stanley, UBS, JP Morgan. Official data tells us that over 40% of all stock trading in America happens off the regular exchanges. Almost half the market is in the shadows. Insane, right? Now, how do these operators make money? From four different faucets. First, they take a commission on every trade just like any casino. Second, they sell the data on everything that happens in their pool. Third, they use the dark pool as a hook to reel in the big clients and sell them other services from the bank. But the fourth faucet is the explosive one. The operator sees something nobody else in the world sees: what the giants are about to buy and sell in real time, before the public market knows a thing. It's like playing poker while picking at everyone else's card. In theory, inside the bank, there's a concrete wall separating whoever runs the dark pool from whoever trades for the bank itself. In practice, Crossfinder, UBS ATS, Posit by ETG, all caught and fined because that wall had some pretty spectacular cracks. When that wall crumbles, the operator is no longer providing a service. They make money by selling the secrets of their own clients. Dark pool are machines that squeeze money from every angle: commissions, data, cross selling, and above all, the priceless advantage of knowing before everyone else what the biggest sharks in the ocean are up to. The activist investor. Imagine buying a piece of restaurant that you think is going down the drain because of the chef. Then you grab a megaphone and shout in the town square, "Fire the chef, change the menu, sell off that location because it's losing money." If they listen and the restaurant starts making money again, your piece is worth more. You got rich not by luck, but because you forced the business to change. That, in Wall Street terms, is the activist investor. Carl Icahn, Bill Ackman, Nelson Peltz, Elliott Management. These are the sharks of the trade. People who make CEOs across the globe tremble. The playbook is always the same. First, they buy a big chunk of a company, usually between 5 and 10%. They file an official document with the SEC, the US authority, which is basically a declaration of war. Third, they publish super detailed presentation explaining to the world why that company is badly managed and what should be done about it. Fourth, they start hammering management with legal battles, media campaigns, shareholders' votes, all out war basically. Elliott Management, founded by Paul Singer way back in 1977, now manages about $65 billion and has gotten its hands on all kinds of companies. Tech giants like Twitter, industrial behemoths like Honeywell. Nobody is too big to be a target. Does it actually work? The number says yes. A 2015 academic study analyzed these campaigns and found that in 20 days around the announcement of an attack, the target company's stock goes up by an average of 6%. And the real improvements, the operational ones, last at least 5 years. It's not a flash in the pan. It's a full-blown revolution. The activist investor is the exact opposite of the quiet, Zen-like index fund we saw earlier. Here, the game is focused, loud, confrontational on the attack. Activists don't make money by guessing where the market is going. They make money by forcing the company to become something different from what it was before. The PFOF wholesaler. You know how you buy stocks for free on Robinhood or those other phone apps? Well, hold on tight. Free doesn't exist. Never has. You are paying, you just don't realize it. Let me explain the trick. Robinhood doesn't charge you commission, but it sells your order to one of those giants. Citadel Securities, Vertu, G1X, they pay to get it. It's called payment for order flow, which literally means I pay you to receive your client's orders. Kind of like a wholesale market for orders. hence the name Wholesaler. Why they do it? Because it's profitable. They execute your order, flip it onto the real exchanges, and keep the price difference. We are talking crazy numbers here. In 2022, wholesalers paid about 2.6 billion to brokers to snag these orders, but the actual profit they made on top are way bigger, between 4 and 7 billion dollars a year, all from the trades of regular people sitting on their couch. But now, here comes the interesting part. The part that explains why it works. When you buy 100 shares of Apple from your phone, statistically, you know nothing about Apple. You have no clue where the price is going. You're just following your gut or some guy's tip on TikTok. To the wholesaler, you're gold. You're a predictable, harmless client they can profit from with zero risk. Orders from big institutional funds, on the other hand, are dangerous because those guys often know something the market doesn't know yet. So, wholesalers dodge the big fish like the plug and focus on the little fish, meaning us. The PFOF system is a perfect machine that turns retail trading into nearly guaranteed profit for the middleman. The big question is, do we little guy actually benefit because we get free trading and slightly better prices? Or would we better off if we could go straight to the exchange? The uncomfortable answer is that both things can be true at the same time. When something is free, usually you're the product, except for the free academy. If you haven't done it yet, click the link in the description. The prime broker. Imagine that hedge funds are Michelin star restaurants. The chefs are brilliant, but on their own, they can't do anything. They need someone to bring them the ingredients, rent them the kitchen, lend them the knives, keep the books, and even front them credit when supplies get too expensive. That someone in the world of finance is the prime broker. The three absolute kings of this business are, as usual, Goldman Sachs, Morgan Stanley, and JP Morgan. Basically, every hedge fund on the planet runs through their hands to operate. Without them, the sharks can swim. How do they make money? From 1,000 of different faucets, all running at the same time. First, stock lending. When a hedge fund wants to bet against a stock, what's called shorting, they need to borrow those shares from someone, and that someone is the prime broker, who lends them out for a fee. Fees range from 0.5% to over 50% annually, depending on how hard to find that stock is. Second, lending actual cash. Hedge funds use leverage, meaning they play with borrowed money. If they have 1 million and invest 3, the other 2 came from the prime broker. Interest stacked on top. Third, trading commissions. Fourth, fees for holding assets in custody. Fifth, sixth, seventh. Every service is a faucet dripping dollars. Morgan Stanley's dedicated division alone pulled in over $20 billion in 2023. But there's a dark side, a monster sleeping under the table. In 2021, a fund run by a guy named Bill Huang called Archegos, or Archegos, blew up like a bomb when his bets went south. His prime brokers were left holding the bag. Credit Suisse lost $5.5 billion. Nomura nearly $3 billion. See the trap? The prime broker rakes in money hand over fist when things are good. But when one of their clients blows up, a piece of them blows up too. Their entire model rests on a silent bet that their clients will never die. When someone actually does die, the prime broker discovers the most uncomfortable truth in finance. They thought they were selling risk management, but really, they were just selling risk tolerance. And the bill comes all at once. Absolutely brutal. As you can see, the smartest move is always to risk someone else's money, never your own. That's why it's essential to use prop firm in your trading. You pocket the gains, they eat losses. Check out the link in the description.